3 months into 2024, and to say the future of the real estate industry is in question, well, that would be a bit of an understatement. Things are looking both positive and negative at the same time. Let's dig in.
I'm Ron Burgundy?
Who typed a question mark on the teleprompter? For the last time, anything you put on that prompter, Burgundy will read.
Well, we hoped for a better 2024 in real estate and lending, and well, we got a mixed bag at best. The NAR settlement sent the real estate world into a frenzy, and the chances of the Feds lowering rates dwindle with every hot inflation report that hits the wire. We're all over the board today, but so is the industry, so let's strap in for some randomness. First, the Fed spoke last week, and let me boil down to this. They see 3 rate cuts coming this year. That's good, but it's also fewer than the market expected. The market had priced in about a 90% chance of a Fed rate cut in June, and now that's only down to 60%, guys. And I honestly think it's 50-50 at best. Here's the most recent Fed dot plot. 17 officials predict a rate cut this year, while just 2 see no rate cuts. Off with their heads. Just kidding. They're probably right. Only 1 official sees the Feds cutting rates by more than 0.75 this year compared to 5 in December, and no officials see rates ticking higher in 2024, so that's good. The updated projections suggest the Federal Reserve will maintain a higher for longer policy stance as a central bank works to bring inflation back down to its 2% target. Again, muddy at best. Higher rates are also responsible for the locked-in effect that we've discussed several times now. It's nice to see the mainstream media talking about it now too, though. Here's an interesting graph that shows the impacts of the locked-in effect and what can happen if we do see a rate improvement. As you know, the locked-in effect has suppressed home sales, and this is showing what would happen if rates improved. It's kind of crazy and shocking to see the impact of higher rates, though, and the fact that it's suppressed home sales by 57%. Another shocking impact from higher rates is affordability, or lack thereof. Take a look at the national payment to income ratio. It's the worst it's been since 1984. And let me remind you, rates topped 18% in the early 80s. So there's that. Here's another interesting result and impact of higher rates. Investors have been forced to alter their buying strategies, leading to some local market shifts. Investors are pulling back in housing markets such as San Francisco, San Jose, Riverside, San Diego, and Los Angeles, as it's hard to find positive cash flows in these pricey markets. As a result, they're buying up more in places like Indianapolis, Philadelphia, Denver, Milwaukee, St. Louis, and Columbus, Ohio. For perspective, here's how to interpret the investor purchase to sale ratio. A 1 would represent for every investor home purchase, there was 1 investor home sale. So 1-to-1 would be a balanced approach. Anything above 1 would indicate investors are buying more units than they're selling, and under 1 would be the inverse. I hope that makes sense. Congrats to Denver, you guys are the winner, and not just because you guys booted Russell Wilson over to Pittsburgh. Investors are buying at a 1.6% ratio in your town. Wait, that's not really a congrats moment if you're a homeowner looking to buy a primary residence in Denver. Nevertheless, you got rid of Russ, and now you have the most investor interest at the moment, so that's cool. I think that's it for this week's show. You can mark yourself safe from talking about the NAR lawsuit today. Hopefully that was a nice little break from your news feeds, and I know we were a bit random all over the board this week, but so is the industry, so I guess we're on point. See you guys next week.